Hi, everyone. Today, let's talk a little bit about the markets. We got some interesting charts to go over, and then we'll talk about my thesis and positions going into Monday. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this every single day that the markets are open, as well as Sundays, so make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So starting off with this article, I've talked about a lot of the topics in here, but there's a few things that I wanted to mention a little bit. They talk about the unimpressive earnings being lower than expected, profits went down 1%, jobs report was really hot, causing the Fed to likely keep rates higher for longer. Hourly wages rose 4.4%, slower than the previous 4.8%, but still pretty fast. Unemployment rate at record lows at 3.4%. But they mention there is a strong disconnect between the market and the economy. The economy is still slowing down, earnings are still going lower, but the market is rallying extremely aggressively. They also talk about how bond yields are continuing to go higher, putting pressure on stocks and disappointing growth, potentially pulling down earnings. And then they reiterate the fact that ARK Innovation is up 42% this year, and the market is basically going bananas. You can see what that looks like. ARK Innovation going extremely high, NASDAQ slightly below, followed by the SPY, and then the Dow is basically flat on the year. And finishing up the article really sums it up. The Fed is expected to pause in the coming months, keeping interest rates higher for longer, which should put a lid on the S&P's high PE multiple, and that we should value-oriented stocks, and that the picture is not quite bullish, but not quite bearish either. Starting off with the S&P 500 here on the weekly view. This is the SPX, and you can see we have these very long trend lines that go back really decades, hundreds of years, as far back as you really want to go. And they give you some pretty decent ranges on where we've been historically. And you can see we're right on this trend line here, which is this middle trend line. This marks a bottom here during the Great Financial Crisis, interacted with it here multiple times during 13 and 14, marked an area of support during 2018, 2019. And if you go back even further, you can see it marks a bottom here in 2002. Marks another bottom here in 1990, 1988. Very long trend line. Has marked price action for a very long time, and you can see it marks a top here in 2018 as well. Marks that little bump before we had the COVID drop. We gapped through it here, multiple interactions over the last 2 years, and you can see we are right here once again, stopped right there. We did throw a wick through the trend line, but we stopped right at it with the body of the candle. And so over the next week, we have to see exactly what happens here. So if we do get a gap through it, or if we have a candle break movement through, so similar to this where you come right to it, candle breaks, and then you get another candle to the upside, certainly possible, just like this move. Or you could get the rejection, right? So we came up to it last time, that exact spot during the November high here. And then we got the big candle down, came up, tested that exact spot one more time, and then rejected. And then we made that higher low here, and it would seem to me that we could get a candle break and move higher. So you could get that candle break, and then a couple more weeks of upward price action, potentially. Of course, we are fairly extended here, not super extended on the weekly chart, but if you look at the daily chart, we are extended, and we definitely have to pay attention to what happens here. We could certainly reject from here, come back in, test support one more time, down at about 4,000. And then get a bigger push through and maybe test this upper trend line up at around 4,500. Certainly a possibility. If we don't find support here, then you have to be looking for a move down to 3,700, 3,800 in that area. And by the time we get there, you would expect the 200-week moving average to be in that vicinity as well. So a couple of scenarios there. Could go either way, but we are at a key point and we have to look for that direction going forward. Moving over to the NASDAQ on the weekly chart, you can see we have this trend line right here interacting with the price action multiple times. That's right where we are right now. We had our first interaction here in October of 97, touched it on the way down from the dot-com bubble in December of 2001. Took a very long time to get back to that level, but we got there right at the COVID high. And then once again, you can see we're right there. We touched it. We got rejection. Does not look like the same scenario as the SPY. This looks more indicative of a rejection and a move down. Certainly possible. We didn't close right at that level like you would expect if you are going to get a movement through that price. So to me, the NASDAQ looks a little bit more like a rejection candle and that we're going to get a retest of support. Certainly possible we come down, test support at about 11,600 maybe, make a slightly higher low. That would coincide basically with the high here in November as well. Come back to that level, test that most recent high, making a higher low, and then you would get the push through if that's going to happen. And then you would be looking for a move back up to the August highs for your next price target, up at around 13,600 on the NASDAQ. Moving over to the Russell, similarly, we have this trend line right here, which has marked a lot of tops and bottoms, very strong trend line. See, hit it multiple times here in July and August of 2019. Got resistance there in October of 2020, goes back to a top here in May of 16, bottoms in October of 14 and October of 15. Many times interacted with this exact trend line. Once again here in May of 22, came up, stood there, got rejected, came up, got a candle break through, and then eventually got rejected from the upper trend line, and then gapped through there and moved lower. And then right here, we're at the level where you could definitely see a candle break and a move higher. Certainly possible, just like this. Doesn't have to be spot on to that level. And you could really move this just slightly if you had to make it fit a little bit better with the price action. But either way, you could certainly get a candle break and a push higher. But if we do start to get some rejection into next week, then you would expect to come back down and test this lower level at around 1860. If we do come back into that level, I would definitely be looking for a bit of a bounce at that level, make a higher low potentially, if this trend is going to hold. And then you would be looking for a break to that next level up around 2150 or so. That would also coincide with the highs that we had here in March of 22, as well as the lows back here, basically throughout 2020 here on the Russell. Moving over to the NASDAQ divided by the Dow and divided by the Russell, you can see pretty extended here versus the Dow. Did come into this resistance level back from May of 2. Also, this is the daily chart, and you can see we closed just below that 200-day moving average. And if we do get steps down here, that's probably going to mean the overall markets are moving lower. The NASDAQ probably going to lead to the downside, as it tends to lead in either direction that the overall market is going. Looking at the NASDAQ divided by the Russell, a little bit harder to read here on the daily chart. Does kind of look like an expanding wedge. But you can see we came into that resistance level, started breaking down, indicating once again that the NASDAQ is likely going to be leading to the downside and that the Russell is probably going to hold up better than the NASDAQ. Moving over to the SPY divided by gold, basically did exactly what we thought it was going to here on the daily chart. Came into this support level, talked about that last time. This is basically your bottom at this point. And then the SPY started moving significantly higher. Gold rolled over a little bit. Certainly at a key point, could see a retrace, maybe come back down to this 23 level and then a continuation, but I would expect SPY to start looking to break out here. Of course, there is some pretty clear resistance up here, which is why I'm saying I think we get a rejection before we get a continuation higher. We certainly have to watch these trend lines here and look for that reaction. If it doesn't push right through, you could certainly get a consolidation and a push lower, 200-day moving average, indicating that gold could still outperform over the short term, but it seems like we found a solid bottom here so far. Moving over to the SPX divided by the Russell, you can see SPX has been struggling. The Russell's been outperforming, and that seems like we're set to continue going into the next week. It is pretty overextended, but momentum is picking up here once again recently. And if you look back in history, you can see we are in the upper range of that trend, and this certainly has more room to the downside, potentially. Moving over to my favorite long-term chart, this is the SPX divided by the M2 money supply. Once again, showing like we are in a possible rejection area right at the 200-week moving average on this chart. It's worth noting that this does not move the same way because it is divided by M2. So that 200-week moving average is fairly significant, acts more as like a center line here. And anytime you're below it, you could certainly expect to move lower, just like we did here. And then when we come up to it, certainly could push through. We did get a rejection here in April, and we did bounce off it and go a little bit higher here from March into April. If you go back in history here, you can see during the dot-com bubble, we did get pretty extended to the upside, well above 200. And then during the Great Financial Crisis, we did get pretty well below it. But pretty much for the rest of the time here, you can see we're generally within that range. And this level that we're at now is a pretty historical average. In 2003 all the way up until 2007, we were in that range. And then here from 2018 all the way until the COVID move, we're pretty much in that range as well. So this is a pretty standard range for the SPX divided by M2. Remember, we talked about it last Sunday video. M2 is actually moving down for the first time ever since the M2 supply was created. M2 has been getting bigger, and it's finally decreasing here for the first time. And that's obviously because of the Fed and their tighter monetary policy. It is interesting right where we're at here. Based on this chart, you can see we're basically in line with the August high. We touched that level of rejection, which marked the lows pretty much throughout 2018 and 2019, besides bigger move down that we had in 2018. So based on this chart, you would expect rejection. Looks more like the wick that we got on the NASDAQ. Looks like we're going to potentially move down, possibly test support, maybe come back into the same level that we had during that December low. I'd be pretty surprised if we tested the October low. I don't think we're going to go that low. But if we came back in, tested the December low, certainly possible. Maybe we come down, make a slightly higher low, and then get the continuation up. I certainly don't think we're going to come up and retest the highs. That does seem unlikely. The COVID high and the high in November of 21 is a very extended level. We haven't been that high since the dot-com crisis, since the dot-com bubble. Obviously, we know how that panned out. So right here, a pretty normal level, slightly extended to the upside in the short term. Could get a retrace, could get a bounce higher, but I wouldn't expect a move to all-time highs in the near future. Moving over to the put-call ratio, I want to highlight that basically we trade between about a 2 ratio and a 0.5 to 0.6. And basically from about May of 2017 all the way to January of 21, we were in this weird downtrend, which is pretty unusual. Usually there's a lot of static, generally staying in that same range. You can see here there's a big void. We didn't really have any spikes of puts to calls, which is pretty interesting besides the move here in March of 20, which we quickly recovered from. That would be the COVID dip, continued this down move, and then really right here in January of 21, we basically started this uptrend, which is interesting. But it is worth noting here recently that we've kind of been breaking out of this a little bit. We've had one candle below, staying in this lower range. It's obviously hard to put your finger on it, but it might be moving into that lower range of puts, which tends to mean you might be moving into a little bit of a bullish period. We talked about it before. I'm pretty neutral on the markets going forward. I don't think we're going to see huge swings to the upside or the downside at this point. I think we're kind of back into that more normalized range. And it could be possible here where we see a break of this trend and we start to level out here. It's definitely something that I'm watching for. I'm not quite sure what it means for the markets. Usually a lower put-call ratio means that there's a little bit of complacency or bullishness in the market. People are not buying a bunch of puts with the anticipation of the market going down. Of course, if there's a lot of puts in the market, that could also mean that the market is going to go higher because most traders are not correct on market direction, to include myself over the last month. But this is something I'm watching for. Does seem like we're in this lower range. Does seem like there's a little bit of complacency in the market. Potentially get a short-term retrace and then maybe start a slower downtrend on this put-call ratio, indicating a potentially longer-term bullish price action going forward. Moving over to the stocks above their 50-day average as well as their 200-day moving average. Looking at the weekly chart on the 50-day, you can see we're still in that upper end. Certainly has not broken down yet. Certainly could hold up there for quite a while. Does not have to automatically break down. You can see we've had many weeks where we stayed up in this upper range as we were rallying. Then you started to see this kind of downsloping movement throughout the last year. Certainly interesting to see what happens here. We're at high levels, but it doesn't mean we have to break down. So we'll have to keep an eye on this going forward. Otherwise, looking at the 200-day average, you can see this is a consistent uptrend. We're still making new highs here. We are a little extended. You could certainly expect a retrace. We did get to overbought conditions here on the RSI, which we haven't done since all the way back in August or here in December at the highs. So certainly interesting getting into overbought conditions finally, going back to levels that we saw in October of 21 or all the way up into the highs here, basically right at that level, right before we started seeing bigger drop-offs. So we'll have to keep an eye on this. If it does start to roll over, maybe get below the 9 EMA on the daily chart, could indicate a slight move down. Certainly would expect some support down at the 45, 46 level, which is basically the high here from August. But right now, this trend is still up. You can see underlying strength in this rally and that it's not completely empty. Let's talk about copper here just for a moment on the weekly chart. I don't talk about copper often, but it is a pretty good indicator to see where the economy is going. Copper is used in pretty much everything, all electrical systems, construction, super important to the economy. You can see here it's been uptrending. This is mostly driven by the reopening in China, in my opinion, but we did come into a resistance line here. We did get rejection over the past 2 weeks. And if this does start to break further, that could be an indicator that the economy is going to be weakening over the longer term. And it's definitely something to keep an eye on going forward. Rejection at a trend line going back to the highs here in March of 22 and April of 22. Once again, rejecting at that level, a bit of wedge here going back to March of 20 and the lows here in September 22. Certainly come back into the level, find support, and break out. Something to watch for sure. But overall, you would expect short-term downward price action. And then if we are going to base continue higher, you would be looking for that. You could also note that this is the 61.8 Fibonacci retracement, so looking for that retrace. Let's take a quick look at real estate. This is a super interesting chart. You can see we bottomed at support here in October, which is a very different chart going back to the COVID lows, going back to the lows here in January of 2019, interacted with the same level multiple times here in March of 2018. Very strong level, did get a very strong bounce, got back into these trend lines, found some support, noting that real estate has not broken out of this downward channel yet. Hit that point basically right on the nose, and then got rejection. We're also sitting just below the 200-week moving average on real estate. Real estate doesn't move quite the same. It's fairly flat over the longer term, at least from the REIT perspective. So we'll definitely be looking for a rejection here. If it does start to break down, that's another sector that could be moving to the downside, in my opinion. Moving over to XOP, I haven't talked about this one in a while, but it's basically been sitting on this 55-week moving average for quite a while. And you can see this momentum is starting to cool off. On the longer time frames, it's good to put an arc in here sometimes. Try to capture some of the highs. You don't have to capture every single one, but it does kind of give you this feeling that we're peaking out here. We've already topped, created a slightly lower high here. We're starting to find some resistance. And you can really capture quite a few highs if you go back. Got the break, couple of highs here in January of 21, high here in June of 22, tested the high once again here in June of 22, came pretty much into that same zone over the last two peaks. Expect that this looks like it's going to roll over. You can see weekly momentum picking up to the downside, broke the 50 RSI. Looks like XOP is looking to move lower. We've talked about XOP moving lower for quite a while here, but it's really been holding pretty steady over the last few months. It does seem like we're pretty much at a breaking point here. We're right at support. If it's going to break down, you would want it to break down right now. And that would be another sector here looking to move to the downside, potentially at least over the next few weeks. Moving over to the Invesco Dynamic Leisure and Entertainment ETF, probably not one you've seen here recently. I don't look at this a lot, but it is interesting because services have really been coming back here. So this has a lot of hotels and restaurant style companies, Texas Roadhouse, Hyatt, Wynn, companies like that. And you can see here, this actually does look like we're creating some kind of a bottoming formation. We have a low, higher low here. It does kind of look inverse head and shoulders. Kind of hard to mark out the neckline here. Probably slanted neckline. We're right at that high going back to August. And if this does break out here, there is some underlying strength in services and leisure. Looking at the last jobs report in detail, you can see that services were very strong. Service job growth was very strong and definitely needed that. It was one of the hardest hit sectors. But understand here that there's a little bit of strength left in entertainment and that we're starting to bottoms here, looking to break above 200-week moving average. Again, not a sector that moves a ton, fairly flat over the longer term. You can see we're pretty extended here during the reopening play of 21. And then we started to slope down. But it is worth noting that this does kind of look like a breakout. And if we can get above this 4240 level, then there's certainly potential that this continues to move higher and gets to overbought conditions on the weekly chart, giving a sector where there's still some growth to be had. Lastly here, I want to talk about Meta. I haven't really talked about Meta that much, but they did do really well on earnings. They beat on subscribers, and they did beat on monthly users and how much they make from each monthly user. And that's part of why you can see this big upswing here. They've been on a really big downtrend all the way from about $385 down to $88, $89. And since then, it's more than doubled back up to $186. This is definitely one of those things that is propping up the markets. It's a very big company. And you have to understand that when you have a company that dips this much and rallies this aggressively, that does create some underlying strength in the markets. This is kind of what we're seeing in a lot of those growth companies that have fallen off like 75, 80, 90% over the last year. So there's definitely companies like that out there. They're just not usually big companies like this. I don't think anybody expected Meta to fall off a cliff quite like this. When you have underlying strength in a company, especially a big company like this, start to come through, that can really prop up the markets a little bit higher than you would expect. The bottom 490 companies in the S&P 500 are struggling and they are probably underpriced at current prices. Then you have those top 10 companies that are sitting at pretty high multiples, generally in the 20s, and Meta coming back into the fold, starting to gain some strength here, is likely to be propping up the market in the short term. You can see it's really just getting back into a more normalized range. The last time we were in this range was pretty much throughout 2017, 2018, 2019, a more normalized range for Meta. And once again, I would expect it to stay within this range. Certainly could get rejection based on this parabolic move that it had. Almost overbought here on the weekly RSI, which is generally a pretty good indicator that you're going to be moving lower. But based on their earnings, you should expect them to stay pretty decently strong, and I would expect support to come in around 158 per share. Moving over to my accounts, you can see still not doing great on the here, down a little more than $5,000, certainly not great. I did make a little bit of money on Friday, which was nice. I made a little bit of money on Monday, but really got beaten down throughout the week. I was pretty bearish throughout, and I made money on Friday, but again, it's been a struggle with the huge rallies that we've had. Again, I'm still bearish here. I sold some naked calls here at 309. I do think we're going to be moving lower over the next week or two. But like I said before, I don't think we're going to go all the way back to the October lows, not unless something changes in the macro environment. Overall, I think we're probably going to stay in a range. I don't think we're really going to trend hugely in one direction or the other, unless the macro environment changes fairly dramatically. If we do start to see earnings drop off really strongly in Q1 and Q2, that could certainly push markets lower. If the Fed randomly decides to raise rates more aggressively and we don't get the 25 basis points like they've been talking about and then a pause, that could certainly change things. But right now, everything seems to be in a fairly decent homeostasis, certainly extended in the short term to the upside, and you could certainly trade that to the downside like I am. But overall, I think we might be in a decent range, a more normalized range for the foreseeable future. Let me know down in the comments section if there's any charts you would like to go over, or if there was anything interesting that you saw throughout the video or new information that was good for you. Definitely like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. I make this video every single day that the markets are open, as well as Sundays, so make sure you don't miss out on any of those videos. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.